Lowe's is quietly becoming one of the most compelling dividend stories in retail, and smart money is paying attention. In this video, we are diving into our 7-step analysis to uncover why billionaire fund manager David Katz is accumulating shares of Lowe's. What exactly makes this home improvement giant so appealing, and with expansion plans kicking in soon, could now be the ideal time to invest? Well, to answer all these questions, we will be using Forecaster website that is very kindly sponsoring this video, but more on them later. Lowe's Companies is the second largest home improvement retailer in the US, with over 1,700 stores across North America. Starting in 2026, the company plans to open 10 to 15 new locations annually, positioning itself for steady growth. If you invested $1,000 in this company 10 years ago, today those shares would be worth something close to $3,424. And this company also pays dividends, so in that time you would get $392 as dividends. So if we add together the current value of shares and the dividends, we get $3,816, and that is a gain of 281% in 10 years. That's a solid result for a mature retailer, especially considering the consistent dividend income along the way. So let's see who benefited from this growth. Individual insiders, that is an X, only 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%. So unfortunately, the management doesn't really have its skin in the game. And are individual insiders buying? That is also an X. If we go to forecaster.biz and look at the overview of Lowe's Companies, we see that insiders bought 1,000 shares in December 2024, but apart from this one transaction, they are only selling. And do super investors own this company? That is a check with two super investors. Thomas Geithner and David Katz both see value in this home improvement giant. And are they buying right now? That is a check. David Katz bought 21,206 shares in recent months, showing continued confidence in the company's prospects. So while insider ownership is low, experienced investors are accumulating shares. Let's see what the fundamentals tell us. Return on invested capital. That is a check at 20.7%, and we want to see this number higher than 10%. So that shows that the management is doing an excellent job generating returns on invested capital. And what do we know about net profit margin? It is a check averaging 7.8% over 5 years. And the sector median is 4.4%. So Lowe's is significantly outperforming its retail peers when it comes to profitability. And now let's take a look at share buyback. It is a massive check. In the last 10 years, they bought back 43.4% of shares. So long-term investors own a much bigger portion of the company without investing any extra cash. And the debt, it is an X. It would take 4.5 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years. So that is definitely something to keep an eye on, but maybe it is not at dangerous levels for a mature retailer. But financial health is only one aspect. We also want our companies to grow. revenue growth. That is an X at 4.1% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So revenue growth has been modest, which is typical for mature retailers. Free cash flow growth, that is also an X at 6.6% in the last 10 years. Again, not spectacular, but steady. And earnings per share growth, that is a check at 16.3% in the last 10 years. This is where those share buybacks really shine. Even with modest revenue growth, earnings per share have grown nicely thanks to fewer shares outstanding. So growth is mixed, but the company is effectively creating shareholder value. If we go to Forecaster website and look at value generation, we see that shares outstanding are decreasing, shareholder yield is increasing, and weighted financials are also increasing. And that makes Lowe's a robust company that is rewarding its investors. When we look at the history of shareholders' yield, which is basically a measure that combines dividend yield, share buyback, and debt paydown, we see it is always between 3 and 7%. Only during COVID it was negative. Also, when we look at the revenue breakdown, we see that US represents almost 93%. So there is a huge amount of international possibilities for this company. And now let's take a look at the dividends. The dividend yield is 2.1%, so shareholders can expect to get $4.80 annually per every share. And the payout ratio, that is a check at 37.2%, and we want to see the payout ratio somewhere between 20 and 50%. So Lowe's is right in the sweet spot, paying a meaningful portion of earnings while retaining enough cash to grow and buy back shares. And what about dividend growth? It is a check at 15.9% 5-year growth rate. That's excellent news for income investors. Lowe's has consistently increased its dividend payments, creating a reliable and growing income stream. So we know Lowe's has solid financials, strong dividends, and effective capital allocation. Now let's see if the current price represents good value. Price to earnings ratio is 18.1. That's reasonable, especially considering the dividend yield and buyback program. But to calculate the intrinsic value of this company, we will use a discounted cash flow analysis. Okay, so first we have to estimate the growth of Lowe's for the next 10 years. So in the Lowe's scenario, we will estimate a growth of 6% for the first 5 years and then 5%. This is close to the predicted growth of the industry, which is around 5.9%. In the medium scenario, 9% and then 8%. This shows a story in which Lowe's slightly outperforms its peers. And in the high scenario, 12% and then 10% growth. This is closer to the earnings per share growth we've seen in the last decade and represents Lowe's growing twice as fast as the industry average. So with such estimates, the intrinsic value in the Lowe's scenario is $177, in the medium $232, and in the high scenario $290. Now we must always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the Lowe's scenario $124, in the medium $162, and in the high one, $203. And the current price is around $224. So it appears Lowe's is trading close to fair value, or perhaps it is slightly expensive, depending on which growth scenario you believe in. And if we go to Forecaster and look at the valuation, we see that the average fair value is almost exactly the same as our high scenario without the margin of safety. Of course, this valuation is created by using discounted cash flow, Peter Lynch method, economic value added, and enterprise value to sales. Now, if you would like to use Forecaster for your own analysis, then I would really appreciate if you would use my affiliate link that is in the description. You will be supporting the channel, but also you will get a free trial, and if you use a code BOLD10 at the checkout, you will get 10% off your purchase. So thank you, Forecaster, for sponsoring this video and helping me to grow this channel. So there are several things to like about this company. Lowe's has solid financial health with strong profit margins and excellent returns on invested capital. The company has an impressive track record of rewarding shareholders through both dividends and massive share buybacks. And with expansion plans calling for 10 to 15 new stores annually starting in 2026, management is confident about future growth opportunities. But we should also consider the challenges. Revenue growth has been modest, and the company carries significant debt. The retail environment is competitive, and economic downturns can impact discretionary spending on home improvement projects. However, Lowe's appears to be a well-managed company. The combination of growing dividend, active share repurchases, and expanding plans suggests management is focused on creating long-term shareholder value. So for investors seeking a bit of income and modest growth, Lowe's presents an interesting opportunity, especially if you can buy shares during any market weakness. If you enjoyed this video, make sure to press the like button and check out my analysis of the Coca-Cola company. Thanks for watching and see you in the next one.